Okay, we are back online again. Are you guys able to hear me? Is the sound coming now? Can you hear me now? Is the sound better now? Please give me a thumbs up if you can hear me. Is it audible now? We had some sound issue. I think it should be fixed now. All right. So, yeah, so I was talking about, great, the audio is clear. How will elections, so Mega asked, how will elections affect investments in small cap funds? So, as I was saying, election is a large political event और उसका impact तो होता है, लेकिन there is no, there are two things to it. One is short term में there will be certainly some impact. किस डायरेक्शन में होगा, वेदर इट विल इंक्रीज द स्टॉक मार्केट और वेदर स्टॉक मार्केट विल हैव करेक्शंस बिकॉज ऑफ द results of elections. Nobody knows in advance. People can make predictions, but there hasn't been anybody in the history who has been able to consistently predict the result, the effect of elections on stock market consistently every time. So that is one thing. So it's very difficult to predict how will elections affect the stock market, for that matter, any, whether it's a large cap fund or small cap fund. So instead of focusing on these large events, on these political events and elections and all, the best way to approach this problem is to um, continue investing in the stock market at all levels. So you should continue your SIPs, and that's how you should deal. That's how you can stop worrying about the effect of elections on your investments, because you're building wealth for a long term. All right. So next question is, um, so next question is by Arati Ashok. I want to invest for 2 years. Which large cap fund is good for me? Please suggest. So first of all, 2 years is a very short investment horizon as far as equity funds are concerned. So it is always suggested that if you are going to invest your money in any kind of equity fund, your investment horizon should be at least 4 to 5 years, because anything less than that, you can never predict how the stock market is going to behave in that time. But 5 years is 4 to 5 years is a safe period where you can put your money in the stock market through mutual funds. So which large cap funds are good? So first of all, 2 years. So for 2 years, it's not really a right investment horizon. But what you could do is, for if your investment horizon is 2 years, you could put that money in the debt funds instead of equity funds. In debt funds, there is far lesser risk and there is very less volatility, and that way you can be sure कि after 2 years आपको जब पैसे की ज़रूरत पड़ेगी, whenever you need to withdraw money, you will be able to withdraw without any losses or temporary losses in that. Yeah. Next question is, hi sir, I want to invest for long term. So so which is a good mutual fund? Okay, which is a good option? So again, what is the definition of your long term? What do you mean by long term? Usually we recommend that anything more than 5 years is, you can call it as a long term. So 5 साल से ज़्यादा के लिए अगर आप इन्वेस्ट करना चाहते हैं, then you could say कि okay, I am investing for the long term. And if you want to invest for more than 5 years, you could go for a large cap. You could also go for multi cap, or even mid or small cap, provided in case of small cap and mid cap, you should think about investing for at least 7 to 10 years. But 5 years, if 5 years is your investment horizon, it's always recommended that you could go for large cap funds. Which large cap funds? You can go to Grow's website, and you can actually search for what are the available large cap funds, and then you could look at their ratings, you could look at their performance in last 5-10 years, you can look at their portfolio breakup, in what industries they have invested. So that way you can make a selection, and you could pick up 2-3 funds and start your SIPs in those large cap funds. Next question is equity fund good or should I have to choose other funds? Every so The definition of good is again very subjective. Is it good? What In what terms do you, what is good for you? So first question is, what is your expectations from an equity fund? Do you want to are you expecting 5 6 7% from an equity fund? If that is what your expectation is, then you could very well invest in FDs, because FDs give you that kind of return. But if your expectation is more than 5 6%, then you could think about going for equity funds. But the moment you say you want to invest in equity fund, then you have to be little patient. You cannot put money today and withdraw tomorrow. As we always say in all our AMAs and all our talks with the investors, is that investment in equity funds means that you should always invest for a long term. That means at least 5 years should be your investment horizon. You should not put any money in equity fund which you think you may need in next 3 4 years or less than 4 years. Next question is best mutual fund portfolio for youngster 22 years of age. So for somebody who is young, so there is this concept of human capital versus financial capital. So somebody who is young, he has very long runway ahead of you. So if you are 22 years of age, you have at least 40 years of working life left in front of you. That means you are going to make a lot of money through whatever active profession you are involved in. That is your human capital. That is the capital through which, that is the your human labor capital, which will that will generate money for you. And somebody who is old, maybe he's approaching old age or retirement age, for him his human capital is almost going to come to an end, but he's going to rely on financial capital. So somebody who is young, because you have a lot of human capital left in front of you, you can take more risk with your equity capital, with your financial capital. So your investment, so there is this thumb rule which says how much of your investment should be in equity versus how much should be in debt. So there is a 100 minus rule which says you subtract your age from 100, and whatever is left, that much percentage of your investment should be in equity fund and rest should be in debt fund. So if you are very young, let's say 22 years, so you do 100 minus 22, so you have 78. So based on this thumb rule, about 78% uh, uh, of your investment should be in equity funds and rest 22% should be in debt funds. But this is a very approximate rule. Of course, you have to think about your immediate financial goals. If you are 22 years, doesn't mean that you will not have requirement for capital in next 5 10 years. Probably when you're getting married or you're planning to go for higher education, you might need funds. So at that time you might need to withdraw money from your investment. So you have to think about all those factors. Next question, is it guaranteed to invest in liquid fund? I have some money in my account and not interested in interest. So if I invest in liquid fund, will it decline based on the market conditions? So liquid funds are considered very, very safe. So they are almost as safe as putting money in a FD. But theoretically, the risk is slightly higher in liquid fund as compared to फिक्स डिपॉजिट. बट फिक्स डिपॉजिट में भी रिस्क तो होता ही है. लेट्स से आपने किसी बैंक के में फिक्स डिपॉजिट में पैसा डाला और बैंक बैंकरप्ट हो गया, देन द ओनली लाइबिलिटी दैट बैंक हैज़, द ओनली इंश्योरेंस दैट यू गेट इज ओनली 1 lakh. सो इवन इफ यू पुट मे बी 5 lakhs of fixed deposit and the bank goes bankrupt, it shuts down, you will only get 1 lakh back. So that way, theoretically, there is risk even in fixed deposit. But liquid funds are very slightly more riskier than your FDs, but they are very safe as compared to equity funds or any other funds. So if you want to maintain cash, if you want to park your cash, you can always take advantage of liquidity fund. Advantage of liquidity fund over FDs is that you are not penalized when you withdraw money because there is no tenure. In FD, you always get interest based on tenure, whether you are making an FD for 6 months or 1 year or 3 years. Based on that, interest changes, and if you break the FD in between, you are penalized. But in liquid funds, there is no penalization. There is no exit load. There is no entry load. You can put your money anytime and withdraw money at 1 day's notice. Next question is, how about mere asset equity direct growth for a period of 10 years? So it's a multi-cap fund, good fund for, so if your duration is, your investment horizon is 10 years, it's a good choice. You could also think about exploring more in the space of small and mid-cap funds because you're saying that your investment horizon is 10 years. So 10 years is pretty long time, and you could also take advantage of small and mid cap funds that will generate higher returns as compared to a multi cap fund. Next question is, please tell about SWP, how to start. So SWP is basically systematic withdrawal plan. Just like you have SIP, systematic investment plan, you could also have systematic withdrawal plan. What you could do is you could invest in any debt fund of your choice, and then what you could do is you could drop a mail to support@groww.in, and then we'll help you start your SWP. So that's how you could take advantage of SWP. Just drop a mail to support@groww.in and indicate your choice of debt fund where you've invested and how do you want to go about withdrawing your money. Next question is, how Fed interest rate increase decrease affect the Indian and US stock market. So you could think about the Fed interest rate as you know, as a, so Fed, they use interest rate as a control to to control the temperature of the economy. So when economy starts heating up a lot, for example, if stocks are going up rapidly and stock market Sensex is, or the index is going up, everybody is very bullish and very optimistic about the stock market. Then what Fed does is they usually increase the rate. So when you increase it, so there is an inverse relationship between Fed rate and the stock market. So usually when rates increase, people the bonds become more attractive as compared to stocks. So large institutions and people pull out money from the stock market and they put it in the fixed income securities, fixed income instruments, and that's how when Fed wants to boost up the economy, if the economy and the business is laying low, and if it's very people have very pessimistic outlook towards business, then Fed will decrease the rate so that people take out money from the fixed income securities and put in the stock market. So that's the approximate relationship between increase in the rate and the stock market, but it's not always linear. It doesn't really happen that they change the rate and it immediately affects the effect immediately comes. Sometimes the effect is delayed, sometimes it's very rapid and immediate. So it's one of the measures which Fed uses so that they can control the temperature of the economy. So yeah, and I forgot to mention. So it's good to understand the relationship between Fed rate and its effect on the market. But as an individual investor, as a small investor, somebody who wants to invest for the long term, you should not really worry about these macroeconomic events. Just like we talked about elections, elections might have temporary effect and they could have a severe effect also. But over the long term, all these macroeconomic events will not matter. What will matter is the consistency with which you keep investing in your chosen mutual funds and stocks. Next question is, how power of compounding works in mutual fund. So power of compounding, so there is this compounding. So actually there is no real compounding in case of, especially in case of equity mutual funds, because there is no fixed rate of return that your mutual fund generates. However, in case of fixed debt funds and FD, there is a compounding there because you keep getting a promised rate of return. So compounding is visibly working there. But in case of equity funds, there is no fixed rate. So compounding, actually there is no compounding. But over a long period of time, when you look back at the performance, the increase in the price of your NAV, you can back calculate how much return that asset, that equity fund or that particular stock has generated for you. So it gives you a way to compare assets, right? So when you look at returns from a particular equity mutual fund, and let's say you invested for 10 years and after 10 years your money has increased. For let's do a simple example. Let's say you put money in the equity mutual fund. In 7 years your money, let's say your money doubled in 5 years, right? And you put the same money in a debt fund and it doubled in maybe let's say 8 years. So what happens in debt fund, there is a fixed interest rate. So for any debt fund or any FD which doubles your money in 8 years is typically giving you 9% interest rate, and that is fixed. They have promised it. But in case of equity mutual fund, there was no promise at the beginning. But at the end of 5 years, your money has doubled in 5 years. So that means effectively you have got 5 years doubling money is almost like 15% interest rate. So your effective compounding interest rate comes out to be 15%, which is far, far more than what you got in an FD or a debt fund. So that's how the idea of compounding you could use to make comparison between equity mutual fund. So, but in actually there is no compounding in equity mutual fund. So you have to keep that in mind. I want to start an SIP 5,000 to 8,000 per month. Where should I invest? Where I can get at least 20% returns. My age is 38. So you have to understand this. When you say 20% return, do you know who is the world's most successful investor? Everybody knows Warren Buffett. Do you know what is his record? How much return he has been able to generate on the money on the money which he has invested? It's around 21 to 24%, right? He has been doing it for last 20 or last 50 years. So just imagine if the world's best investor has been able to do only 21 to 24%. Expecting that you as a small investor will be able to do 20%, it's like an over expectation. So it's not that there are no funds who have not done 20%. There are funds who have done much more than that. But the idea is, if you are investing money for a long term, expecting a 20% return over a very long period of time, I would say it's a very high expectation. You could make that 20% returns in 3 and 5 years, but again, it's always looking back. You could look back at funds which have done 20% in last 3 years, but that doesn't give you any insight about whether they will be able to repeat their performance in the future. So you have to always think about long term, how much long term you should, what's your long term horizon, and expecting 15 to 16%, anywhere between 15 to 16% over a very long period of time from stock market, whether it's through stocks or equity mutual fund, that's a reasonable expectation. So you could start an SIP. You could choose to, if your investment horizon is 10 years, you could choose small cap funds, or you could distribute your money across large cap, mid cap, and small cap funds based on when do you need the money in future. Next question: should I buy a house or invest in shares or mutual funds? So one of the ways to think about is this: whenever you invest in buying a house, the question is, what is the purpose of buying a house? If you're buying a house for living in it, then maybe you could go ahead and buy a house. But if you're thinking about buying a house and as an asset, as an investment, if you're thinking that you will buy a house and put it on rent, and then in future the price appreciation, you could make money through it. So that may not be a very good idea for a small investor, because first of all, the rental yields of real estate in India are very, very low. In US is much better, but in India it's like 2 and 2.5%. The other disadvantage is you cannot make small incremental investments in real estate. If you have to buy a house, you have to shell out a big amount, you have to take a loan. But in stocks, you could start investing with as small amount as 100 rupees, and you could diversify. You could invest in fixed income securities. You could take advantage of small cap funds and mid cap funds. So you could do all those optimizations, and the barrier to entry is very less. So maybe if you want to buy a house, if you have a good knowledge of real estate in your area, you could do that. But also I would suggest that you diversify some money towards mutual funds and stocks also, because it offers you much more flexibility. And of course, the question of liquidity is also there. If you buy a house and if you want to sell it, it's not as easy to sell your house as selling your equity mutual fund units or stocks. So you have to keep those things in mind and then make a decision. Next question is, how safe is SBI Technology Opportunity Fund? So it's a sector fund, and inherently, structurally, sector funds are little more risky than other equity mutual funds. And why is that? Because usually when a fund is a sector fund, one of the problems with that is the mandate of the fund manager can only invest in the companies which are in that sector. And if the sector is not doing well, and it is evident to everybody knows that sector is not doing well, even then the fund manager cannot really withdraw money from his sector companies and invest in something else. He has to stay invested in that fund. So that way it becomes very risky. But if you are an investor who has good insights, who has good idea, who has good knowledge about particular sector. So if you are from technology field and you understand technology, and you understand the overall health of the technology industry in India. And if you look at particulars, for example, if you look at SBI Technology Opportunity Fund, and if you look at the companies they have invested in, and you have some confidence about how those companies are going to do in the future, then maybe you could take a call and put some amount of your net portfolio in sector fund. But again, you have to accept the fact that sector funds are inherently more risky than any other equity mutual funds. Next question is, how fund size matter? So fund size matters in a sense. So first of all, if the fund size is a too small a fund, and if a fund is too big, both are not actually good for the investor. Why a small fund is not good? That's because if a fund is small, no, so in a mutual fund there are certain restrictions put by SEBI. So if somebody is running a very small fund, let's say 100 crore size fund, so SEBI has a restriction saying that you cannot put more than 5% of the fund's net worth into a single stock. Similarly, so what happens is, even if somebody fund manager finds a very good stock where he wants to invest more, where he thinks that the prospects are very good in the future, he will not be allowed to put a small more than 5 crores out of 100 crores. So that's a restriction that mutual fund manager has. So that's why a small fund, those are the disadvantage of having a small AUM. If you have a very large fund size, then that also becomes a kind of a disadvantage, because the bigger the fund size is, the problem what happens is a company cannot acquire. So again, the same SEBI regulations comes in, that they say that a fund cannot acquire more than 10% of the company, right? So if fund size is, let's say, 10,000 crores, and a fund manager finds a very good company which is, let's say, growing very fast, it has good prospects, and that company total market capitalization is 100 crores, then that fund cannot buy more than 10 crores. That fund cannot invest more than 10 crores in that company, because of the restriction by SEBI saying that you cannot have more than 10% of a company. And that 10 crore whatever he puts in that company, even if it becomes 10 times, it will only become 100 crores. And in the size of 10,000 crore fund, that increase of another 100 crores, it will not move the needle much. So the bigger the fund size, even that is not very that's the disadvantage of fund. So usually the bigger the fund size, usually it is good to go with bigger fund size for an investor who's a new investor, because the possibility of making mistakes, so is the cost of making mistakes is very less. So in a small fund, if a fund manager invests 5 crore rupees in a small company and it goes down, you suddenly lose 5% of your net worth. So that's the risk which comes with small funds. नेक्स्ट क्वेश्चन इज 5000 SIP पर मंथ करना चाहता हूँ, इसका इंटरेस्ट किस में सही होगा? 5 years का. So if your investment horizon is 5 years, you could choose either large cap funds, or you could even go with multi cap funds. Um, Again, if you when you say interest, when you say how much will be the interest, you could expect a reasonable 12 to 15% returns in this period. But again, it is not guaranteed like any other debt fund. So again, if your expectations are low, if your expectation is only 7-8%, 9%, then maybe you could go for a hybrid fund, or you could go for debt funds also. But if you're expecting more than 10%, 12%, then maybe you could choose multi-cap fund or a large cap fund. My age is 25. How many MF should I have from which sectors? So, there is a famous investor. His name is Peter Lynch. He was the fund manager of a large mutual fund called Fidelity's Magellan Fund in US, and he managed that fund for around 13 years. And he had very good returns, around close to 20% CAGR annual returns he generated for his investors. And he used to say, that owning stocks, and I would say that what he's saying for stocks is true for mutual funds also. He used to say that owning stocks is like, having children. You should not have more than what you can manage. So if you have too many funds, then it becomes unmanageable, right? You have to keep track about how each fund is doing, how much SIP is going where. Although with technology that has become easier. So if you are using our Groww app, it will be much easier to track all these funds. But still, at the mental level, you will always be thinking about if I have like 5, 6, 10 funds. Second thing that you have to understand is mutual funds are inherently diversified. What does it mean? If you were to invest in a stocks, maybe you could invest in 4 or 5 different stocks, but when you buy a mutual fund, that mutual fund is already investing in 15, 20 stocks. They have already distributed your money across 15, 20 stocks, so it's already diversified. And the purpose of diversification is reduction of risk, so it becomes less risky when you don't have all your eggs in the same basket. So now imagine if you have 5 mutual funds, or let's say if you have 10 mutual funds, and each mutual fund is invested in, let's say, 15 stocks. So effectively, all your money is distributed across 150 stocks, which is too much. That much diversification is not really required. And at this age, if you are very young, at this age, you can afford to take more risk. As I answered in one of the earlier questions, you have a large runway ahead of you in terms of working life ahead of you. You have a lot of human capital left, so you can take risk with your financial capital. So maybe you could have money invested in 2, 3 mutual funds, good mutual funds, and you can begin from there. And about the sectors, which sectors, don't just go by which sectors are doing good now, because all those things change at some point of time. Some sectors will be doing good, some other point of time some other sectors will become good and some will become bad. So it's all cyclical, if you understand a sector, you should go for investing in sector fund. But if you don't have any above average understanding, um, then I think you are taking unnecessary risk. So investing is very important, that you should know what you're doing. You should have a rationale, you should have a reason for what you're doing. You should not just invest in anything, or what you heard a tip from somewhere, or somebody suggest you something. You should always think about what you're doing. Next question is large and mid cap fund for 15 years. Yes, 15 years is a pretty good investment period, and you could even think about going for small cap funds if that's how long your investment horizon is. Um, Maybe you could invest via SIPs, and then the longer your investment horizon is, one of the things which becomes important is you don't just say that I'm going to invest for 15 years and I've chosen few funds, and then I'll just close my eyes and keep investing. You have to monitor the performance of your funds. You have to monitor what's going on. So maybe once in a 6 months you have to review what funds you have, how well they are doing, what's going on. But not more than that. Once in 6 months is a pretty good review period. So I think we are approaching the end of today's allotted time period. It's already 2 o'clock, and I think it was good today. We were able to take many more questions today as compared to earlier sessions, and I hope you guys found today's session useful. So stay tuned. We will continue doing these AMAs in future also. Next week we will inform you in advance the time. Most probably we'll be doing an AMA on Thursday, as we have been doing for past few weeks. Until then, happy investing, and I'll see you again next week.